Welcome back. You're watching Start Up Central with me, Nayantara. If you've been following the recent fundraise activity that we've been seeing on Startup Street, you would have seen a lot of announcements that have been coming in of the medium to large startups going in for an option called venture debt. Now, venture debt is not your regular debt. This is not debt provided by banks where you all go and give collateral and provide some regular income, because as we all know, the startups also don't maybe necessarily always have a steady monthly income. It can go up, it can go down. They may not have assets. They're not interested in building assets either. So they go to those that specialize in venture debt. So today on Startup Central, we've got a special for you. One of the pioneers in venture debt in India, BlackSoil, has agreed to do this masterclass on Startup Central. And joining me is the big boss at BlackSoil, the founder, Ankur. Ankur, thank you so much for agreeing to this masterclass. We'll today focus on some of the basics. My first question to you is, what exactly is venture debt? And also, what kind of startups should even look at this option at what kind of a growth stage?
So I think venture debt is basically a debt which is used as a terminology very commonly when any startup is using it, looking to raise debt. And generally the phenomena has been, and the way the markets have been working on it has been that they have been backed by already by a VC investor who has put in some kind of equity money in the company. The reason of that is that there are so many startups out there. The kind of companies that a lender would like to work with should already have some kind of people backing behind it, and the justification sort of comes from the fact that a VC gives that kind of benchmark to it. So that's where any kind of VC-backed company sort of all becomes eligible to raise debt as such at a very, very high 30,000 feet level, I would say. That's how the sort of the market has transformed to it. Obviously, over a period of time, now there are a lot of bootstrap companies who have not raised VC money, and they also have scaled well. They could also become potential for raising debt. But how the market has been so far, it has been like almost 95% or 99% market has been behind people who have raised some kind of VC funding. So when they have raised equity money, that could be at early stage, it could be a Series A stage, B stage, C stage. So they always need some kind of capital which is in complement to the equity money, right? So that's where the debt money comes in. So it's not very different from a regular term loan or non-convertible debentures, NCDs that have been used by any corporate to raise money. It's similar to that. The only differentiation comes in is that apart from taking regular interest servicing coupon, one also attaches an equity upside in the form of a right to invest or in some sort of a warrant. So that gives them an equity kicker to the lender, right? Because the companies obviously are still at early stage or still not profitable, or the companies are yet to reach the stage where they can start making a lot of cash flow. So that risk that one takes, for that one takes an additional kind of kicker in forms of a warrant. So that's how sort of the components are for the debt perspective. So one is a regular term loan, which could be 12-month loan, could be three years loan. It is regularly interest serviced. Coupon ranging could from as low as 12-13% can go up to like 17-18%. Again, depending on the stage of the company, right? So all these commercials sort of come into the picture depending on how large the startup is or the kind of risk the lender perceives when they're looking at investing in the company. So this is now obviously very fast growing space now, because obviously the VC itself has grown in multiple times since 2013, 2014, where the market boomed from then. And the venture debt market has been slowly following the same trajectory. And I believe almost last year, 2020 was always a breakout year for venture debt market. And more than 350, $400 million has become the market size itself, which is very small. Compared to how it is in the US, which is almost 12 to 15% of the US market size. India is still at 3.5-4% of the overall VC market. So there is a large scope for expansion further. And as the companies are growing further, as you can see how 2021 has begun, there is a lot of traction in among startups in further fundraising. Venture debt will also be playing a good role in that. Helping companies achieve various kinds of objectives in that aspect, how they strategically use that to take care of some of their business needs. And that's where sort of venture debt has been sort of really picking up quite well. And the number of players in the market are also increasing, and the kind of sophistication in the product is also going much more than what it was 4 years ago.
Okay, so this is pretty much clear that those startups that are bootstrapped, venture debt is not for you. So then when is it exactly, Ankur? Like, is it after Series A, after Series B? Should it be only between C and D or post that? And how does venture debt, if it's not for bootstrapped and those who already have equity and are growing, how does venture debt then score over equity?
Sure. So Series B and C would be majority of it, but a lot of transactions happen at Series A stage as well. Series A also has becoming larger in size now. There was a time when Series A used to be like maybe $2 million or $3 million. Now it has become like $5 to $6 million minimum. So along with that, a $1 million kind of check size is a good entry point for a venture debt player, because you get to know the company at early stage and you develop a relationship with the company. And as the company scales further for Series B and C, you sort of become the first call for the founder, right? So that's how it is, that you want to attract companies at early stage. You work with them closely, see how they grow, become their another kind of soundboard, which is very different from venture equity guys, whose main focus generally is equity. Growth of the business, and venture debt sometimes a little bit more conservative in nature in terms of how they want the business to be more sustainable on the unit economics front. So that's how sort of it plays out very well between the two kinds of capital stack that one has. So in terms of the second question that you had, I thought of sort of just forgot, which was the second question you asked?
I was asking you how venture debt scores over equity. You already have equity investors at the cap table. If the startup is doing well, I'm sure those equity investors would want to double down. So how does venture debt score over equity?
So the reason why people take a debt is very simple, is that it does not result in any kind of dilution for them, right? So at any stage, founder would like to keep as much as control and stake that they can have in the company. So the first biggest benefit that they get is avoiding any kind of equity dilution for them. So even if it's a $10 million round and $2 million you raise as debt, so 20% additional stake, which would have gotten diluted if you would have sort of taken equity instead of debt, that is a straight saving for him. So that's one of the many large benefits that people have seen. But apart from that, now there are other use cases also which are coming in. For example, you're a company which is on the B2B side. You have a lot of inventory. You may have receivables. So you don't want to use equity money to finance it. So why would you not use debt to finance your working capital? So that is more efficient. Equity money is extremely expensive. It is not expensive on the face of it because you're not paying any interest on it, but it results in dilution. And equity investors obviously want a higher multiple of on their interest, right, on the investment versus debt. So from that perspective, people like to use this for working capital a lot. There are a lot of companies. The second use case which we have been seeing a lot is companies which are close to EBITDA break even. They would like to extend their runway. And they would like to achieve the EBITDA number. So that sort of changes the entire dynamics of looking at the startups, from somebody who's burning cash to somebody who's already sustainable on that nature. So they like to use debt for that aspect. Sometimes they use this money for contract financing. Companies, some of them really get a lot of large contracts and they want to use that debt for financing it. There are the other use cases. If I'm getting into an acquisition, I want to acquire another company. I don't want to pay everything using my stock, or if I don't want to use entire equity round to sort of finance it, I can use some part of it using debt. So a lot of interesting opportunities have been coming like that, where people find it important to use venture debt as an alternative, and not just keep using equity to raise money and keep diluting themselves. And sometimes you even raise the money in between rounds, and that extends the runway significantly and helps you, attain a higher milestone, which results in a higher valuation for you. So even like a 3 to 4 month extension of runway for a fast growing company could mean a very significant improvement in their valuation. And there are times where the founder may look at it more conservatively, and he likes to, keep more money in the bank, so that you're not really worried at last moment to close the round. You need to have enough funds with you, that you don't really want to sign up a transaction which is not at great terms that you were looking for. So different mindsets come into play, different depending on the company's thought process and the founder's mindset, and even the investors who are backing it, how they want to use debt as a strategic tool to sort of achieve their overall objective that you're looking for. And as companies are becoming interesting in terms of the profiles and the kind of growth they're seeing, even the debt guys are also getting more and more sophisticated and trying to get customizing their product solutions also with the requirement of their.
Okay, I get it that founders may not want to part with precious equity, but they're still going to have to repay debt regularly. That's just the way the debt instrument works. And what if they're then at a cash burn stage? The equity partners are willing to wait for any kind of a repayment or whatever it is. And we only talk about the successful startups, but we all know that most of them don't make it. Most of them anyway have 6 to 7 debt-like instances. So what happens to you venture debt guys in that juncture, and what happens to the startups who've taken venture debt and then for whatever reason on the verge of collapse can't pay?
So I agree. So that is where the entire sort of risk matrix of any lender comes into play, right? So it's like any lender in the market, whether you're in microfinance or whether any kind of other business, you have to ensure that your underwriting standards are a certain level that ensures that the company is going to be repaying your money at any point of time. So every lender has their own strategy to look at their underwriting process and how they perceive risk in any company. And as you rightly said, obviously you can't expect all startups to give you multi-bagger returns or all startups to keep raising money. So that's where sort of your understanding of the businesses become very critical. So which are the kind of companies would want to back, right? It cannot just be driven by whether a large VC fund is behind a company. It is also important to see whether the business itself is interesting enough that we feel that will keep scaling or growing, or at least in a worst case scenario will get acquired by potentially another strategic investor. So a lot of other thought processes go behind when you're evaluating a company, right? So you would not want to back a number 5 player in the same ecosystem that somebody is playing with, or you may not want to back somebody who's directly head-on, maybe working in a vertical against large e-commerce players. So one has to sort of see what kind of business that they are trying to build, what kind of economics they have, what kind of runway they have, and more importantly, the kind of burn they have. So there will be lenders who will be very comfortable possibly with a large cash burn, and there will be lenders who would like to fund companies which are less cash guzzling companies. So depending on your risk metrics, one sort of figure out the kind of businesses they want to back, and there are enough out there right now which fits your kind of mindset, and one can sort of try and go forward to those kind of transactions, right? So yes, there will be chances, there will be situations where the company does not raise next round of funding, and that's where sort of the real underwriting quality sort of transpires for any potential lender. So, and at that point of time, obviously the equity investors and the founder also understands the kind of risk that they're taking when they take debt along with it, because it's not a permanent capital. It has to be returned at one point of time. Sometimes that interest servicing generally is not a challenge because it's a very small percentage in terms of the overall capital flow that the company has to burn. It is more to do with the perspective that they have to return the principal amounts, right, in the form of EMI, etc. So that's where sort of the real test for any lending sort of situation comes in, how well they are able to keep collecting their funds.
We'll leave it at that, Ankur. This has been so helpful. We're going to keep getting you back. This was a simple one with the simple questions. You're going to get into the technicalities of the complex ones in the second episode of the masterclass on venture debt. With that, ladies and gentlemen, we're taking a short commercial break. Now, come March 25th and 26th, the Times Network will be hosting the India Economic Conclave. The best minds from global markets, corridors of power, India Inc. will all be in New Delhi for this year's edition. It's India's largest digital conference. The theme this year being, this is India's decade, reform, perform, and transform.